Hello and welcome everyone. We will commence the webinar very shortly. Make yourself comfortable, grab a drink, a coffee, some lunch, sit back and relax. We're in for a treat today. Just give it an extra minute or two. I can see the number of participants going up, which is great. So we will commence very shortly. Hope everyone's ready for a little Easter break. Can certainly do with 4 days break. It's been a very intense start for 2021. An exciting one. Okay, just give it a few more seconds and then we get cracking. Okay, I would say we get started. So thank you very much for joining us today. My name is Giovanni Ferrante. I look after marketing operations for CIPS in the ANZ and Pacific Highland region, and I will be your host for today's session. The session title is Rethinking Risk in a Digital Economy, and we have two brilliant speakers, as you can see from the screen today. Kia ora to all of our New Zealand friends and everyone else joining us from all around the regions and beyond, because I know often we have people from other parts of the world. So welcome everyone. Before we get started, I'd like to acknowledge the traditional owners of the land from where I'm dialing from, and that's the land of Bunurong and Bunurong and Wurundjeri Wurrung peoples of the Eastern Kulin Nation. And I'd like to pay my respect to the elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander people on this webinar today. So a couple of housekeeping notes, or Zoom keeping notes as we call them. The webinar is currently being recorded and you will be sent a link to the YouTube channel where you can rewatch the session, share with your colleagues or peers. And you'll also get additional information. I won't unveil what they are because that's a little surprise. You're all in listen-only mode, i.e. you are muted, but we do encourage participation. So please interact with other attendees and with our speakers through the chat function. And you'll have an opportunity at the end to ask questions directly to the speakers. So please engage. That's your opportunity to pick the brilliant mind of the two presenters we have today. So please do engage. Alrighty, enough chit chat. So straight into the session. Way too often, procurement professional or risk professional feel being accountable of things that are outside of their control. So reliance on digital vendors constantly rising, commercial and third-party risk are only set to increase. So procurement must take a leadership role in enabling accountability, and risk should be shouldered across the business. It is everyone's responsibility, as you will hear through the session, and all the way through the C-suite and every single person within the business. So without any further ado, the two presenters we have today are Stuart O'Neill, who's the Managing Director for APAC at Coupa, who's the kind sponsor of today's session, and Tom Sykes, who's the Head of Procurement and Commercial at Sykes. So thank you both for joining us today. And Stuart, over to you.
Yeah, thanks, Giovanni. Absolute pleasure to be here, and thank you for the invite. Listen, I'm going to start off the session by actually talking through something fairly topical. We're talking about risk, obviously, from a digital economy perspective. What I've got is to provide something a bit topical. We've pulled together a WBR report that goes across essentially 200, not only CPOs, but it was actually CXOs as well. So CFO professionals, CPOs, etc., with regards to what they saw last year and what they're seeing moving into this year. And it's topical because not only did that become really an area that was stress tested over 2020, but we've seen obviously with the recent blockages in the Suez Canal that risk from a supply chain perspective also affects our digital economy, also affects our inherent and obviously operational risk. So just moving forward, Giovanni, onto the next slide. Going to just talk through essentially this WBR report. It will be made available to everyone who has joined this call. So I probably won't do it enough justice, but I'm just going to cover off some of the top areas very quickly. Essentially, this report basically went over a number of industries. It went over manufacturing, it went over banking, it went over FMCG, it went over basically around 22 different industries and pulled back information from those CXOs. And one of the things that they found is when they were looking back at 2020, there was absolute consensus that risk didn't just sit in the supply chain, risk didn't just sit inherently within the organization. Risk really sat across the entire organization and needed to be owned by the entire organization. There was also very strong agreement, so about a quarter of those who were interviewed agreed that essentially they didn't necessarily have the right metrics in place to be able to understand or assess the supply chain when they were asked, or be able to understand whether their suppliers were under stress, or whether they had the right suppliers, or whether they were able to pivot. And then there were lots of, if they didn't have that information, they weren't able to come up with the right strategies to address some of these areas. And what we saw in the report is there is a clear understanding that they were looking at understanding whether they could use their contract management system to understand which suppliers they had, whether they had the ability to change those environments or those engagements, whether they were able to shorten engagements, etc. And nearly 60% of CPOs also said they weren't very confident in their ability to basically understand all the areas of risk throughout the supply chain. And from that perspective, that's become very topical recently with, again, 10% of the world's shipping lanes obviously blocked off for a number of days. That's impacting everyone in terms of just the raw material, not just the raw materials, but also availabilities of future supply chains as we see the repercussions of this. And we saw similar effects during COVID last year. So Giovanni, we'll move on to the next slide. In terms of how they were addressing this and some of the tools and approaches, if we talked across the organizations, we talked to the CIOs, we talked to the CFOs, we talked to the CPOs, we talked to a number of levels, so either talking to the IT or the business or finance within organizations, we saw that essentially they're addressing this from a number of areas. There was a lot of organizations looking at contracts and trying to understand what contracts they had, whether they could leverage those contracts to be able to streamline their organizations. They were looking at supply chain modeling. They were looking at contingent workforce. All of these areas came into play. So basically, we definitely saw collective ownership of the risk profile across this, the organizations. And I don't want to steal too much of Tom's time because I'd like to get on to the conversations with Tom. So I'm going to move on to the other slide and ask you to have a look at this report and start to pull together some of the areas that are of interest to you, because it's about a 24-page report where essentially the summary comes out that 220 was difficult. 220 challenged a lot of organizations. 220 saw risk get to the board level and be owned by the entire organization instead of board level. And not only from a pure digital perspective, but also trying to understand our third-party suppliers and suppliers of those suppliers. So we basically, the summary was, CPOs believe that definitely it's not just their personal responsibility, it sits across everyone in the organization. So the culture needs to be pervasive. And also functional leaders and teams across the company were not necessarily well equipped. And we're certainly seeing those be addressed in 221. And we're seeing this move on as we move forward. So I'm hoping that we can then talk through operational, third-party, environmental, all these elements of risk, and we're going to cover those in some detail over the next hour. So with that, Giovanni, I'm going to hand back to you, and we can go and hear from Tom.
Brilliant. Thanks for the overview, Stuart. Tom, I think it's your time to take the stage. Welcome, and thanks for making yourself available. Here you are. I'm going to hand over to you.
Thanks for having me. I hope the background isn't too garish, but this is our SEEK procurement policy up behind me. Real pleasure to be here. So thank you very much, everybody, for having me and for taking the time to have this discussion today. As the team might have said, so I look after procurement and commercial at Sykes, and previously I've had roles in Lloyd PwC focused principally on third-party risk management and contract risk. So today I want to focus on rethinking risk in a digital economy, and the amount of times I've heard people talk about rethinking risk or simplifying risk is baffling, but I think it reflects that this is actually a really complex topic. And the couple of things that I want to cover today in this discussion are the evolution of risk, how we've moved from a physical to a digital world, and how some of the risks have changed there. Secondly, our role in modern risk management, particularly as procurement. And Giovanni, you might just want to flick these slides forward as we go. Thirdly, we'll then look at emerging digital risks and approaches. And look, there are 1,000,001 risks that we could discuss today. So I've just picked 3 of the ones that are perhaps closest to my heart. We'll have a chat through those. I will apologize in advance, but my team will always tell me I'm drone on a little bit too long, so I will try my best to stick to time, but please bear with me as we go. So just on to the next slide. This is a bit of a truism, VUCA, right? So volatility, uncertainty, complexity, and ambiguity has exploded, and you don't frankly get any points for saying that. But I think one of the really interesting things for both procurement and risk professionals is the rapid growth in risk domain. And this diagram, which I pinched from the Wall Street Journal, on the left-hand side, really articulates this quite well. So those elements in blue show the risk domains, or the categories of groupings of risk, which we now need to think about. And to be frank, that the volume of risk domains has expanded, the prevalence of them has, but so has their inherent complexity and depth. So that each of these risk domains are just becoming more difficult to deal with. And as I've said here, it's too much for one person or one function to handle, in terms of volume, but also, as I say, in that complexity. And these complexities and growth in risk domains, I feel at least, are compounded by the significant increase in use of third parties. So we're kind of seeing that this exponential growth, if you like, in complexity and frankly just the volume of work. And that makes this discussion, particularly on our role in procurement, really interesting around the separation of accountability and control. And all too often, as Gio was saying, procurement professionals either feel accountable, or we actually are accountable for various things that are outside of our control. And one of the best examples that no doubt everyone on this call is familiar with is when we prepare a lovely contract with all the right bells and whistles, and it goes into delivery, and because those things aren't adhered to, we end up introducing risk. And that separation is something that we really need to explore. Moving forwards to the next slide, I think what Stuart was saying, and ultimately what the survey concluded, is exactly this point. So CPOs believe that risk is everyone's responsibility, and I agree. It is everyone's responsibility, but it's kind of saying with the obvious, right? It always has been, and it always will be. But why I think insights like those that Stuart was talking about are so important, because it really shows the volume of work left to do. So the fact that we're still having a conversation about whose responsibility is risk management, the fact that this can be even up for debate, is really, really important, and just shows the complexity and the gaps. And again, that final point around teams not being equipped really underscores that. When I was talking to student team about this topic, one of the questions was, okay, is why? Why is there still work left to do on this front? And my reflections on it are that risk is actually pretty complex, and clearly there are a lot of really good initiatives to simplify it and make it easier to deal with, but risk is a technical profession. It's just like the same way that commercial acumen is something that everyone on this call has built up over a number of years, through training and frankly battle scars. And it's not just something that we can say is be more commercial and hey presto we are. And that's the same thing with managing risk. We can't just tell people to go and manage risk and they do it. We've got to recognize that this is a discipline unto itself. And from a procurement perspective, of course, we've had to learn about inherent risk, residual risk, controls, and the technical side of things. And I think we've done a great job of that. But if I look structurally at procurement functions, it's really important that our role is not to do everything and to fix everything, as Stuart was saying, but actually that our value is in the ability to connect across the organization and translate risks into business speak or commercial language, and make sure we're making the right decisions as we move forwards. And one of the things we'll talk today is around leveraging those relationships and the controls and technologies that we have to support other functions. So quickly on, as I think I'm already behind, the three things I'm going to talk about today are cyber, value risk, and entanglement. So without further ado, I'll jump straight on to cyber security. And I kind of had to include this one, right? Because you can't have a conversation on digital risk without actually talking about cyber. A couple of weeks ago, I was listening to Michael Pizzillo talking, and he's the permanent secretary at the Department of Home Affairs, and he's had some really interesting points. And the reason the old IBM computer is up on screen is because in the spectrum of cyber security and cyber risk, he was talking about how when historians look back at the past 10 years, they're going to look at this stuff, what's going on today, in the same way that we look at biplanes with canvas, right? It's basic and it's early. But it's nonetheless completely insidious. And one of the things that he was particularly focusing on is how criminal groups all over the world are going digital in exactly the same way that a lot of our organizations are going through digital transformations. These are businesses in exactly the same way, and they too are going digital. And so this notion of an increase in volume, frequency, and sophistication of attacks, again, is a bit of a statement of the obvious. It's coming, it's going to happen. And we've seen this in, I think it's around a threefold increase in exposures in the US over the past year. And one of the fascinating parts of that is that many of these defects, these exposures, are in systems that are ubiquitous. So if you like, the expanding attack surface for cyber criminals is becoming really, really prevalent. So I won't dwell too much on cyber risk in of itself, but just flicking on to this slide to talk about what are some of the things that we can do. And a lot of organizations have done some really, really good things in this space. Strong relationships are, like with anything in life, absolutely paramount. And that's making sure that procurement has really direct lines of communication with cyber and risk teams. Real two-way street, and collaboration is so important on a number of these issues to improve understanding of each other's jobs and what we do. But also hard controls are invaluable to the organization. And this is something where procurement can play a really clear role. And I would say that there's no such thing in risk management language as a soft control and a hard control, but this is just kind of how I talk internally. So soft controls are those elements such as guidance, policies, or post hoc detection, otherwise known as detective controls. And those things are good, they're relevant, we should do them, but there's obviously some gaps inherent in that, and they can create some exposures. And one of the things we need to recognize is that non-compliance isn't just about bad actors, right? Sometimes it's about a lack of ability to identify risk in third-party engagements, or know what to do about it, or even who to go to. And that's where hard controls play a really important role. And hard controlling, in my speak again, is preventative control. So one of the things that we've done at Sykes with Coupa as the foundation is to essentially institute a mechanism where these key risks are workflowed in, so that we can't commit to a vendor, we can't onboard a vendor until the right risk-based checks have been completed. And that goes across the board in terms of business continuity, technology, cybersecurity, and of course legal. And whilst this is great, I will highlight just for everybody on the call, even if you do have these hard controls in place, particularly in the digital space, credit card spend, and particularly business stakeholders purchasing software on credit cards, which totally avoids, of course, some of the core P2P processes. That can still be an exposure which everyone should certainly look at. So shifting gears rather rapidly onto to value risk. So it comes by many different names and very different things, but it's an issue that I find really, really fascinating. So just to kind of think about what's the difference between price discovery and value discovery. So price discovery, what's a good price? We can look at market indices, comparable pricing, industry benchmarks, you name it. There's a whole heap of things out there to work out whether the price is a sensible price. That, though, is rather different to value. And the risk part of this is around essentially opportunity cost, that we're losing value as a result of certain decisions that we might make. So value discovery, really important. That's looking at what is the actual business impact going to be of bringing this digital vendor in a product or service. It's actually looking at price to cost. So not just what is the price in the market, but what represents value. How do we make sure that we're feeling like we're not being ripped off? Really important. Deal composition. So what's in, what's out, how we're ensuring that as we grow the right things are happening and we're still going to get value throughout the life of the deal. And then finally, risk profile. So how do we understand the organization's risk profile, their control environment, and the risk that they present to the organization? So two really important concepts there. Now, this is my super simplistic diagram that ultimately talks about the spectrum, if you like, of what we buy. So on the left-hand side, tangible, all the stuff that we're used to: steel, laptops, pens, great. Human services, so consulting, cleaning, contractors. And then the highly intangible end of town. So software, cloud solutions, great example of an intangible good. Now, one of the elements, of course, in that, and Gio, if you just want to click one button forwards, you end up with a real potential for increasing asymmetry. And the asymmetry that I'm referring to here is in relation to information. That could be anything from information on price to cost. It could be in relation to the different commercial mechanisms that sit in the contract, and of course the risk environment. So what actual exposures and vulnerabilities that organization has. And the more intangible the good or service, usually the larger that asymmetry usually is. And that's something that, of course, we need to address in procurement. And moving just one forwards, Gio, in the intangible space where asymmetry is really high, it's a bad thing because we begin to anchor to market. So 3 vendors might tell us that it's $1 million. Sorry, Gio, one back, please. If we have a number of vendors telling us that a certain type, like a good or service, maybe an ERP, is $1 million, then is that the correct place to anchor or not? We end up with a bit of a self-referential bias and using feelings and heuristics to essentially challenge the deal, which again are not that objective fact-based view of the world that's so important in our profession. And I think one of the important things around intangibles is the emphasis on negotiations that it places. And I see that as quite a bad thing because again, we want consistency of outcomes. We want to make sure that the process is doing its job rather than relying on individual brilliance in the negotiating room, right? So again, when we talk about asymmetry, this can be a bad thing for everyone. On to the next slide, please, Gio. So one of the things that can happen where we have high levels of asymmetry is that firms become price takers without mitigation and ultimately the right things being done around the deal. It can erode early trust in relationships, which creates pretty significant problems, as we all know, for longer term relationships. And of course, we need increasing levels of experience to deal with this asymmetry, both through the procurement process, but also, as we've already said, in those negotiations. So in asymmetric procurements, the need for procurement professionals, as opposed to perhaps the business, to be leading these discussions is really, really important. So in terms of resolving asymmetric procurements, and Gio, just on to the next slide, please. I'm going to hold my hands up and say I don't have a perfect answer. Clearly, in asymmetric engagements, the role of procurement is really highlighted, and I don't think procurement has ever been as important as it is right now in a digital economy where there are such high levels of asymmetry. And again, procurement processes will always help to reduce asymmetry and should continue to be used. We've had a fair bit of success with covariance and correlation analysis, but really solely as it relates to price and essentially the movement of levers against discount, for example, which, whilst valuable, is only dealing with the commercial aspects of the relationship, which is, of course, only one part of what we're trying to achieve. I think the real lever of success is in the deep dive value assessment. So a number of people on the call will obviously do this out of hand, but engaging deeply with a vendor, looking at doing proof of concepts, actually understanding the FTE or the efficiency impacts that a new bit of technology is going to have, and making sure that those requirements are fully delivered is really important. I think whilst that's, again, probably a bit of a statement of the obvious for many people on the call, these initiatives, these engagements take so much time. They take a lot of internal resource, a lot of diligence, and so we can only really justify the cost of these when we're dealing with the really significant elements and vendors. So again, I haven't solved this one. If anybody has, please do let me know. I'd be very keen to hear from you. And I'm clearly over time now, so I will pick up the pace, Gio. Apologies. I want to talk now about entanglement. So entanglement, again, I know everyone on this call will be very familiar with this, but ultimately I'm talking about when vendors, particularly digital vendors, are deeply entrenched within the business, such that they can't be removed or scaled back without pretty significant effort and cost. And no doubt many of you here today will be pretty familiar with tools and bits of software coming into the business, which are then built upon, become so ingrained both at an emotional level with users and frankly at an operational level in terms of what they're doing, that we can't do anything other than formalize that relationship. And I think that's brings us nicely onto the impacts of entanglement. So it means that decisions that perhaps are made in isolation around what's going to happen in the next 6 months can pretty quickly become irrelevant or based on the wrong assumptions. And for example, something that we're planning to do in the early stages of a digital platform engagement, perhaps, that changes pretty rapidly after stuff is built on it, after operational processes and information and data become put onto that platform and we begin to use it day to day. That makes it really, really hard because the assumptions that we might have made on how we're going to use this platform up front might not hold true anymore. And I think frequently I see organizations doing contract planning for perhaps 1 or 2 years because they're perhaps not so sure about what it is they're buying or their confidence levels in volume. But the reality is, because of the way they're going to use this and because of the stuff they're going to build on it, we end up not contracting for 1 year, but for 10. And making sure that we're clear on that up front is really, really important. I think another impact is to look at business continuity. So entangled vendors that are dealing with customer-facing processes or are supporting our ability to deliver to customers is really, really essential to identify those tier 1 questions. Those tier 1 criticality status and treating them accordingly. And then making sure that in commercial negotiations, our leverage isn't eroded. And one of the major problems with entanglement is that because many vendors are quite aware of the significant effort that it's going to take to remove a product or platform from the business, means that actually there's no real negotiation to be had, and that leverage is fundamentally eroded. So whilst I know a lot of organizations struggle with this, I think at Sykes we've employed some really strong and clear ways to mitigate this. The first is managing entanglement risk in the same way that we look at business continuity. So contingency planning being very important, looking at tier 1 vendors, making sure we know who they are, what they do and how they support customer-facing processes, making sure that there's transition planning in place as well, so we know what that exit strategy might look like, even if we're really happy with that vendor. Secondly, then looking at enhanced focus on contract management, making sure that there is early warning on contracts. And this isn't about getting a notification 3 months in advance that the contract's going to end, but sometimes 12, sometimes longer in advance because of the significant amount of work that might need to be done to remove that vendor. Strategy planning, making sure we've got a clear view, and holistically engaging. So this isn't just with the business owner, but with tech, architecture, cybersecurity, risk, making sure everyone is engaged and involved in a decision that can ultimately impact lots of tentacles across the organization. And then finally, negotiated mitigation mechanisms. So the stuff that we can do upfront at the point of contract negotiation in relation to clear offboarding practices and costs and timeframes, in the same way that perhaps we used to do with service and outsourcing agreements. Being really clear on unilaterally awarded extensions, price fixes for any reductions in volumes, even if at the outset of the contract was perhaps not expected. And then finally, being really, really clear on any documentation to understand how our processes currently work today. So Gio, I will leave things there. Apologies, I have run over, but thank you very much for listening, everybody. I hope some of that was useful.
Thanks, Tom. That was brilliant. And don't apologize, we've got plenty of time to go through some questions that I know Stuart has prepared for you. And hopefully it's not going to catch you off guard, but I'm sure there will be a few things that are of interest to everyone on the call. And so I'll hand over to you guys for a bit of a Q&A between the two of you, and then we go and answer some questions from the audience.
Brilliant, thanks, Gio. And Tom, listen, thank you for the presentation. You didn't actually run that far over, which credit to your team. I think they're being a bit harsh. Listen, just very quickly, let's start with, why procurement and risk? Why those two interests, Tom? I've seen, obviously, you've worked with PwC and Deloitte, and obviously you're working with Sykes at the moment. Why is this such an interest for you? And where did that come from? Is it because this is what you're confronting on a daily basis, or has this been a passion that you've developed as seen as a requirement moving forwards?
Yeah, so I probably fell into risk first of all. I actually started life as a barrister back in London, then went on to being a TV presenter, which was kind of a bit of a weird detour. But found myself in Deloitte's risk practice. And again, they're focused on third parties. And it was just after the GFC where there's a lot of regulation beginning to pick up around third parties. And I think third party risk as a concept was really beginning to gain momentum. So I probably fell into it. I think as things have evolved, and perhaps I've been a little bit more intentional about my career and what I want to do, I see risk as just a pervasive thing in life, but of course, in terms of organizations, everything comes back to risk in some way or another. And you've got bad risk and good risk. And I think it's really hard for organizations to achieve the things they want to without having a really good command of risk management, risk identification, understanding how we're going to treat things, and taking informed, sometimes aggressive risk-based decisions is so important. So that kind of combination with the commercials, and in many ways I see procurement as being fundamental to managing that value risk that I was talking about earlier. It's all kind of one story for me. So perhaps something that I'm quite passionate about as a result.
Okay, so I mean, I saw in your presentation you were talking about complexity, and this stuff is hard, and that's generally why organizations don't necessarily address it or don't understand it. But I'd like you to dig a little deeper into, why do you think not every business function is competent in either identifying or dealing with or approaching risk? Just cover that a little bit more from your experience.
Yeah, sure. So I probably wouldn't reflect on it as business functions specifically aren't good or perhaps well equipped. I think risk management is such an individual thing. So obviously, of course, it rolls up to a business function being good or not so good at managing risk. But that is basically whether it's people, it's individuals are good or not so good at managing risk. And so I think, again, some of the things that I was covering around complexity, the fact that people have built pretty impressive careers based on risk, and there's a whole profession that sits behind it. We need to recognize that this stuff is not simple. Identifying and understanding is hard. I think to illustrate that point a little more clearly, if you look at what lots of other organizations have done as well, but particularly in the financial services space, I think it's fair to say that the banks have had some really good success having first line assurance and first line risk people in the business. So this is where a trained risk professional sits on an embedded basis with the business, sits in the meetings and helps them catch things, educate them as they go, and ultimately make risk management easier. I think some of those things, whilst frankly that they're expensive from a resource perspective, the impact that those professionals make is really tremendous, and it is frankly benefits everybody.
So, I mean, I've got plenty of questions, but I'm seeing some come through from the panel. So we will shift gears a little bit, Tom, and start to go to those questions so that we address the questions that are coming up. I think I liked one of your positions, which is it is the rise of the CPO. We are seeing the procurement function start to take on more responsibility. And I heard a comment on a previous CIPS event, actually, where the procurement role was being described as more the guide dog rather than the guard dog. And I think from a risk perspective, that's certainly true. So Gio, do you want to ask, I've seen that there are 3 questions that have come through online, and there's also one on the chat. Gio, do you want to read out one of those questions for Tom so that we're addressing the questions from the panel?
Absolutely, and they're all extremely relevant. So let's start with Alan, who was the first to put his questions. I think they've cancelled his favorite show on Nine Network, who was recently affected by the cyber attack. And he's asking what could have been done in advance to mitigate the risk of that attack, particularly how could procurement gotten involved and actually help preventing, and how do we ensure that those things don't happen again in the future?
Yeah, so to be frank, this is probably outside of my my expertise, and I wouldn't want to comment on this issue in particular, but also cyber risk more broadly, and perhaps what controls or processes that they could have had in place to stop it at a technical level. I think from a procurement perspective, more broadly, our role isn't just to make sure that, again, we've done our due diligence on vendors, or perhaps we've got the right SOC 2 reporting in place. Is to make sure that there are regular engagements with some of those tier 1 vendors, particularly to talk about vulnerabilities, to connect them with the right parts of our business. And to be frank, I don't know if the Channel 9 issue was caused as a result of a vendor or not, but particularly again where procurement is involved, that connectivity that I spoke about earlier is so important to stopping these things happen in the first instance, but also where they do happen. And again, what the comments that I referenced from Michael earlier, these things are going to arise, they're going to keep happening, and so how do we make sure that in the event that they do, are we able to contact the right people? Is there mandatory immediate reporting obligations within the contract? And ultimately, do we have a clear and consistent process that everybody knows what to do when they become aware of something not going quite right?
So Gio, I think then there's a question from Peter and Andrea, and the next 2 questions I've seen. Which one do you want to go to first, Gio?
Let's see, because audience have an option to like the question. I think Andrea has asked it initially in chat. So he's asking, and Stuart, please join in. It's directed to Tom, but is anything changed with COVID in terms of the areas of risk? So what organizations are focusing at the moment, or perhaps they didn't pre-pandemic? So
yeah. So I might talk perhaps about just in the digital space. So the massive rise of remote working, collaboration, and communication tools. So fortunately, I think we were really well placed at Sykes, thanks to our awesome tech and ops team. But a lot of organizations weren't. And whilst I don't think there are necessarily any material risk domains that have changed fundamentally, some certainly might have got more important, I think post-COVID, there is a real opportunity for organizations to reevaluate their risk appetite. So if we look at, let's say, Zoom, an organization that didn't use Zoom before, they managed to implement it in a matter of weeks. And I think, as we all know, getting the right approvals, doing the right due diligence, making sure things have gone through the right checks, etc., takes time. And clearly these businesses needed to move. And so in order to get those things done, and done quickly, they had to either create an exception or change their risk appetite for particularly digital platforms and digital solutions. So I think more thematically, there's a real, the change has been organizational ability to challenge previously accepted ways of working and previously accepted risk appetites.
Yeah, I would agree with Tom. We've certainly seen from my conversations with CPOs, CFOs, etc., a simple example, as Tom was alluding to, digital signatures. Banks weren't accepting anything but a wet signature, and bits of paper sort of had to be carried around the office. Very quickly, that became impossible. So there was a continual shift and a requirement to address the fact that this wasn't that big a risk, and it wasn't that big an issue. But confronting some of those norms and those change was what happened in 2020. We saw those changes. I think they said 3 years of change in 3 months was what organizations will push through. That was the number that was quoted. I also think the other thing is community. We started to learn from each other. We started to share information, and we started to share an understanding of what risk was within our supply chain and be able to use that amongst us. Certainly, that's what I was seeing amongst our customers. And I think that became really powerful in terms of assisting us assess those risks.
Extremely valid point. Thank you both for sharing your views. Peter's asking, and if you guys have any other questions, please submit them now, because we'll be wrapping up in about 5 minutes. Peter is asking, this is a sort of a political question. First of all, he's complimenting you, Tom, for the presentation, very sympathetic to the risk and the procurement function and the relationship side. What approach or approaches would you recommend to help clarify where the responsibility sits? And he's putting that in the context of, I'm assuming, a very wide corporate business. How do you define who's responsible for what?
So, absolutely great question. And I used to spend my time at Deloitte building third-party risk management frameworks for organizations. And one of the first steps in that is to work out who's accountable for the risk domain. And we spoke at the start of this discussion around the separation of accountability and control, and that's becomes really difficult to deal with when you're dealing at scale. So, for example, the person who is accountable, let's say, for anti-bribery and corruption risk, may not necessarily be the people that are executing on those assessments. So again, should they be made accountable for work that other people are doing under the management of another function? So that's probably one challenge. I think, again, in the financial service world, you've got bare accountabilities that have tried to provide a degree of formalized accountability for various other things, but including risk management. But those tend to be the most senior executives in the organization, which perhaps don't have the level of granular visibility and engagement that you need to actually manage risk on a day-to-day basis. So I think that there are probably two things that I would say. That the first one is culture, and risk culture is becoming more and more prevalent. It's really picking up as an art and industry in itself. And to Stuart's survey and the comments that were made at the start of this, we need a culture where everybody feels responsible and accountable for risk. And that's not necessarily a process, that's not ticking a box, right? That is a feeling of ownership and of confidence as well in your ability to manage risk. And so that's really important. I think that the second thing is a bit of a truism, so apologies again, but what gets measured gets done. And one of the things that I've had some tremendous success with recently with my team here is beginning to actively track metrics that speak to risk. And that can be commercial risk, it can be the types of trends that we're seeing in some of the control assessments and various other things like that. When those things get tracked and highlighted, even if they're perhaps not the answer and all the detail isn't there, they're starting a conversation and they're almost making sure that people are seeking out the right accountable person and party in that. So again, I think those two things in conjunction are really important. And procurement has a huge role to play as a platform, but as Stuart said, it's a whole business engagement.
So Gio, I see we're at basically 1:45, so we're at the top of the hour. So I'm going to pause there and basically thank Tom for being very frank and opening up and talking about risk in such an articulate manner, and also for the slides. And then hand back to you, Gio, because I wouldn't want to steal any more time from people's diaries.
That's very kind of you, Stuart. I think we can go with one last question. It seems like we still have plenty of people online. So I think if you're okay with that,
Sure.
I can ask one more question that it's very broad, so that could probably lead to a very wide answer. But how does procurement ensure that fraud, corruption, and bribery risk are mitigated through procurement activities? So that touches a number of areas that Tom referred to or that you alluded to in your risk. But if you have, let's say, your top 3 advice on how can you address those risks within your business using technology or not, what would those be?
So I think there's some really good tech out there in the market, to look at analytics from a fraud perspective, but also in terms of the APAC risk. There's some good inherent risk indicators. It looks like the question is specifically for procurement activities. And in that regard, I'd probably point to having a really good relationship with your risk domain owner. So whoever owns the fraud APAC risk, having a really good relationship with them and being really open about the controls that you have in the business. We actually went through an exercise a couple of months ago to almost voluntarily articulate what are all these kind of core risks, look at the control points that we have, and then do a bit of a design effectiveness review with that stakeholder. And I think be pretty real about the things that you can look at, the things that you can't, the things where you have knowledge, and making sure that if something looks a bit fishy or seems perhaps a little out of place, you're able to put your hand up, and things are dealt with quickly, but also in a commensurate way to what you're talking about, right? So things don't blow up and get out of hand, which can be, I've seen at least a source of reluctance in other organizations to actually escalating things.
Yeah, I think the technology certainly exists out there. Organizations like myself certainly have the capability to look at duplicate invoices, to look at consistencies, to leverage. We have 2 trillion worth of spend, so to leverage the community and that anonymized data to the benefit of specific organizations. So I would certainly be talking to your vendor community about what solutions they have there. Obviously, we're leveraging AI because, as Tom alluded to, the quantity and the amount of data means looking for those anomalies is kind of where you need to be. Not looking at all the data, understanding where those issues exist. And I would be suggesting that definitely those technologies exist. You also have the ability to essentially send out reports and assessments to your supply chains and their third party and continual individuals beyond that. And that helps to start to understand where the fraud sits, to identify that fraud and be able to address it. And we're certainly seeing from our perspective, that's been highly effective in saving companies immense amount of money. And also we see the same fraudsters, we've seen the same patterns occur elsewhere in the world. So leveraging that information from a community perspective to the benefit of each organization that you're dealing with is kind of where we see the value. And we see that that is certainly going to be something that's going to add huge amounts of value moving forwards.
Thanks, Stuart, and thanks, Tom. It's been a brilliant session. If there's one key takeaway I'll bring home from the session is the fact that we're talking about risks in a digital environment, and yet the word that I've heard most commonly used is relationship, and that for me sits at the heart of what business is all about. So even in the amplified digital environment and economy that we operate within, relationships remain key to mitigate risk and beyond. So thank you both for sharing your insights. It's been absolutely fabulous. Before we let everyone go, just a very quick plug. We have our awards program for closest for submission tomorrow. So if you have a good example, a success story, something that you've recently done in the form of a project that's delivered a great outcome for the business, please do submit for the awards. The deadline again is tomorrow, and we look forward to celebrating examples of procurement excellence from around the region. And the second plug is for the next session that we will be hosting with Coupa, and that's on the 19th of May, and the topic is from resilience to renewal. So we're looking at community-powered KPIs, and I can't wait for this session to actually help you spend in a smarter way. So Tom, Stuart, thanks again for your commitment and for your support this session. It's been absolutely invaluable. And thanks to Coupa again for helping us with hosting of this session. And until next time, we ask you to complete a little survey at the end of the session just to give us some feedback so that we improve upon delivering a better experience for you all. Thanks again, Stuart. Thanks again, Tom. Until next time.
Thanks, Jeff. Thanks, everyone.
Cheers.
Thanks, everyone. And thanks, everyone, for joining us.